Greetings, everyone. I'm David Darst here to give you a recap of February. Even though it's a short month, it often manages to pack in some fireworks. It's one of the bottom 3 months over the last 100 years on average in terms of the S&P 500. It's generally down about 0.1%. This year, in contrast, February was down 1.4%. So it was following the script. This month and this year have shown a lot of volatility, and this underscores our positioning recommendation, which is to have alternative investments in there to dampen the volatility. To be more specific, you started out the month with the DeepSeek, the new artificial intelligence engine that's been developed in China, led to a sell-off in many of the artificial intelligence stocks. You then had a series of benign or actually good inflation numbers, consumer price index, producer price index, and then at the very end of the month, the personal consumption expenditures price index. The core consumer price index came in at 3.3% for January versus 3.2% in December. The core producer price index, and core, by the way, means it excludes food and energy, which because they're very volatile. Producer price index 3.4% for January versus 3.5% for December. So you can see this gradual decrease. The personal consumption expenditures, core, and that's the Fed's preferred measure, that had an even better outcome in the month of February, 2.6% versus 2.9% in January. So those were some of the positive things. We had the announcement late in the month of the imposition of tariffs on Mexico and Canada, going to be 25%, as you know. And many people had thought because the administration had given a grace period that it would extend. No. So that, I think, put some pressure on the stock market. It basically caused, and it was associated with, this tremendous decline in consumer confidence and consumer sentiment. Those, I think, are two of the most important things, and they offset these benign inflation readings where you have a big, sharp sell-off, fall-off in consumer sentiment, down 9.8%. You have to go back years and years, decades, to get a decline of that magnitude in the University of Michigan Consumer Sentiment Index. I think part of the reason is people feel these tariffs are going to be inflationary. They feel they see all these headlines about the Department of Government Efficiency, this DOGE initiative, layoffs of government officials and government employees, makes them worried about their own situation. So this was, I think, characterizing the second half of the month, where you had NVIDIA came out with their earnings in the last week of the month, February, after the close, on February 26th, after the close of the market. NVIDIA gave good report on earnings, good report on revenues, but their gross margin disappointed investors, and the next day, NVIDIA fell 8.1%. For the month, NVIDIA was down 7%. So this takes you, and by the way, Tesla is another one that has a high profile right now. That one was down 27.5% for the month, as people were really concerned about the development of their business in China. As a result of this, the S&P 500, as I mentioned, was down 1.4% for the month. NASDAQ was down 4% for the month. And the Russell 2000, which is your small and mid-cap stocks, down 5.4% for the month. Can you believe that the TLT, that's the Exchange Traded Fund for Long-Term Treasury Securities, that was actually up 5% for the month? So I think very few people had been talking at the beginning of this year. Everybody was very positive on stocks and negative on bonds. And look at that. Bonds have outperformed stocks considerably. Europe is up 9.8% for the year to date, whereas the S&P 500 is up only 1.2% for the year to date. Japan is down 6.9%. China is down 1%. The 2-year Treasury and the 10-year Treasury, we don't want to neglect those. As a result of this decline in consumer sentiment and so forth, and this feeling of uncertainty, the 2-year Treasury fell 20 basis points, and it's now yielding 3.99%. Big move downward in yields, and also a big move downward for the 10-year Treasury. It came in at 4.24, which was down 18% for the month. Gold up 7.9% for the year, and oil down 2.7% for the year to date. As we basically position ourselves, you've got these 5 building blocks. The economy, okay, the economy is showing a little bit of further slowing. It's not yet in on the risk or the cusp of recession, but it is showing further slowing. You had 2.3% for the fourth quarter GDP number. The first quarter preliminary estimate was 2.3%. And then at the very end of the month, the Atlanta Fed, which gives you this GDP now forecast, came in at minus 1.6% because of the slowdown in personal consumption and personal income at the very last day of the month. So we'll see how they revise that going forward. Secondly, inflation continues to come down slowly, although tariffs are going to be probably adding to the inflation number. Number 3 is Fed interest rate cuts. 93% chance for the March meeting of no interest rate cut, 7% chance of a 25 basis point cut. And that's fine with our current feeling. We don't think there'll be an interest rate cut, perhaps, unless the economic conditions deteriorate further, until around the middle of the year. Number 4 is the artificial intelligence. And there you've seen a tarnishing, a certain come down of the tremendous bullishness of the last 2 years. And finally is are the Republicans going to be able to generate pro-business and market-friendly policies? Right now, that's up in the air. And that, what I think, is a big question mark as we go forward. That's the 5th building blocks. All of this leads us to a defensive position, a market, a volatility reduction positioning. And that brings us to private equity, private credit. Private credit, you want to lend to businesses with recurring cash flows, high up in the capital structure where you have covenant protection. And in the private equity area, you want to find secondary market interests of partnerships where you already know what they're investing in. It's not a black box, and you can, I think, find some of these at good discounts from their net asset value per share. We also private credit, private equity, in addition, defensive type stocks. There you're talking healthcare and you're talking banks, financials. With that, we wish you a great month ahead. Ramadan Mubarak, and we will catch up with you next month.